Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, we preview what to expect from the busiest earnings week this season as 5 of the Magnificent 7 report results. Plus, we hone in on the Fed, what to expect for its rate path, and who could eventually succeed Chair Powell. Plus, IBM shares hit a record high as the company prepares to release a paper on its quantum developments. We'll discuss that and more on Market Catalysts. First up, let's take a look at the major averages here this morning, not just here in the U.S., but around the globe. And that's because we have been watching all this year the gains that we've been seeing, not just in U.S. stocks, but really globally. And we've been hitting new records around the globe as well, particularly in Asia overnight, seeing some strong gains. Korean Kospi up by 2.5% in the course of the session, and over in Tokyo as well. The Nikkei, it looks like hitting a new record. Here's the year-to-date performance, 27% increases. So many of these global markets have actually outperformed the U.S. year-to-date, but of course, not too shabby here in the U.S. either. If you look at the S&P 500 in the year-to-date performance, it's up by 16% and at a new record today as well. As we get ready for this very busy week, the catalyst today for gain seems to be this sort of more positive or optimistic language that we are hearing out of Asia ahead of the meeting between President Trump and President Xi and possible progress towards an agreement, or at least an agreement to an agreement between the U.S. and China on some level on trade. Right now, we've got the Dow up 250 points or so, the S&P 500 up 0.9%. The Nasdaq continues to lead, up 1.5%, and getting to some of the movers there, it really is large cap tech that is leading the gains today, ahead of earnings for many of these companies. So all of the so-called Magnificent Seven are in the green in today's session, ahead of earnings for many of these companies. Some of the standouts include Meta up 2.3% and NVIDIA gaining 2.5%. NVIDIA doesn't report for a little while yet, so we're not going to hear from that company, but we are getting gains in many of these stocks. And then on the sector level here, not surprisingly, given what I just showed you, XLK, which is the tech sector ETF, is leading gains, followed by consumer discretionary and communication services. We do have some laggards despite the strong gains in stocks today. We've got healthcare, real estate, utilities. All the interest rate sensitive or more defensive sectors are lagging in today's session. Well, let's get to the question really of the year thus far. It has become the question of this AI-dominated market cycle. Are tech stocks in a bubble? My next guest says, based on the data, nope, not in a bubble, at least not yet. I want to bring in Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist, who did a deep dive into this in a recent note, Peter, that I found really interesting. You really looked at a lot of different aspects of this question, including looking at other historical comparisons. But short answer, no, we're not in a bubble. Give us sort of the summary of why not.
Well, thank you. I think, look, first of all, rising equity prices, and you've just described very well how most equity markets, not just the US, are at all-time highs. That's certainly a necessary condition for a bubble, but it's not a sufficient one. You know, alongside rising prices, you need to see intensely increased speculation and rising valuations. Now, it is true that valuations are at pretty high levels, particularly in the tech sector, which is dominating the US market. But really important to emphasize, the dominance of technology in the US and of the largest companies has, at least until now, been fully supported by incredibly strong fundamentals. In other words, it's really been driven not by speculation about the future, but by consistently strong earnings growth. That's one thing. I think the second thing is that valuations, while they may be high, are not nearly as high as we've typically seen in bubbles before. For example, in the technology bubble of the late 1990s, or indeed in Japan in the late 1980s, which was a bubble around real estate and banks. In both cases, valuations were almost double what we're seeing for the big stocks today.
And I used a lot of charts in your note. One of them looked at the price to earnings growth ratio, sort of to the point that you're talking about, and looked at it for information technology, that is the green line here, versus the world. And to your point, we saw it sort of the bigger gap between these two during the dot-com bubble. But what is this chart telling us right now about Is there a level at which you would start to get more concerned here?
Yeah, look, I think what it really fundamentally tells us is that while the technology sector and the biggest technology stocks in the US have outperformed, not just in the last year or two, around the time of the introduction of large language models and intense focus on AI. This has really been consistently true since the financial crisis ended in around 2009. So for almost 15 years, the US equity market has outperformed others, led by its technology sector and increasingly a smaller number of huge technology stocks. But as this chart is showing, although that's pushed up the scale and size of these companies and indeed their valuations, if you adjust those valuations for growth, for profitability, it's pretty much the same as other parts of the world or indeed other parts of the market. So again, fundamentally underpinned, at least now, up until now. The question, of course, is what happens in the future, and are we going to continue to see that degree of outperformance or that degree of fundamental profit growth? That's a question, of course, for the future, but up to now, I don't think it really is consistent with the bubble.
Well, and Peter, that is the question for the future. But if you look to the past, every other or most of those other examples you cite, the answer was no, right? When you look at things like the railroad boom or other situations where an innovation came in, you looked at the dot-com bubble, right? And the build out that we saw of telecom networks, and a lot of the gains were accruing to telecom, and yet that was not a sustained profit driver for those companies.
Yeah, so if we look at the long-term historical experiences of bubbles, and many, not all, but many bubbles have been around transformative technologies. And this has been true going back as far as, the Industrial Revolution, the invention of steam engine, the railway boom, the canal boom, the computer and PC boom, and many others, including the internet boom of the late 1990s. What we find is that a revolutionary technology attracts huge amounts of capital to build out the underlying infrastructure, to really commercialize the technology. But in the end, it's often not the companies that are really doing the spending that end up with the biggest benefits. It is true that usually when you have these revolutionary technologies, you do get significant economic benefits. You get a productivity boost, you get stronger growth, you get lots of new markets and products and services developing. But it's often new companies that come along that are able to leverage that embedded technology and capital to provide and find new products and services that have the strongest growth. So this is really an argument in favor of the transformational effect of technology, but it does suggest that investors should be thinking of broadening out their exposures into other companies that can really grow and scale on the back of these technologies, and indeed other companies outside of the technology sector, which may benefit from that spending, particularly when we recognize that in AI in particular, you have a significant increase in energy demands. Electricity usage is likely to accelerate a lot. That means that we're going to have to see a lot more spending on infrastructure, energy generation and distribution, and that will also create growth opportunities outside the tech sector too.
So, and Peter, this also, it makes me think that, is it a bubble is not necessarily the right question. It's more, where should you be putting your money right now to take advantage of what the innovation is going to trigger down the line? For investors, it's a bit tricky because yes, you can buy, these energy generators, which has been happening, but a lot of the innovation is also happening in the private sector. So if you're an investor, how do you go about finding those accessible opportunities?
Well, the general approach that we've taken over the last year is that despite the increasing focus on AI and technology, investors should really be looking at broad diversification. That means diversification across different asset classes, private markets, public markets, across different geographies. You mentioned earlier on, before our conversation, that actually, although there's a lot of focus on US tech stocks, most other regions are actually performing as well, if not better than the US. particularly in dollar terms, as the dollar weakens. So you're getting this broadening out geographically across different asset classes, across different styles, because it's technology is doing well, but some of these other sectors and more value-orientated stocks are also doing well. So we believe that diversifying and having a broader spread of exposures improves your risk-adjusted returns.
Peter, there's one final question I have about the bubble discussion, or at least the durability of this whole trend. And it has to do with the company at the center of it all, and that's OpenAI. And while as you pointed out in your note, and as you've outlined here, a lot of these big companies, their balance sheets look good, they're profitable. The company that's sort of at the center of it all isn't, right? And so what does that then imply about how sustainable all of this is?
Well, again, historically, lots of companies that have grown extraordinarily around the new technology haven't been profitable at the outset because you need huge, they're very capital hungry companies as they reinvest to scale and to grow. And as you say, there are a lot of very, very large profitable companies in the whole ecosystem, which are helping to support and sustain the growth in the underlying rollout of the technology, the large language models, the data centers, and so on. So I think, in a way, what makes it rather different to what we were seeing in the internet bubble, the dot-com bubble, where most of the companies that were coming to the market in IPOs, or indeed the ones that were accelerating most in price, were actually not profitable companies. So it was very speculative. A good deal of the companies doing the spending right now have very strong balance sheets, have a lot of cash flow, and are doing that spending out of their own profitability rather than borrowing money from the debt markets or increasing the amount of equity financing. So that, in a sense, is a healthy thing, but we need to watch, of course, how that develops over time with more competition.
Right. Stay tuned, and we'll stay in touch, Peter. Thank you so much for your time this morning. Appreciate it.
My pleasure. Thank you.
As we've been talking about, big tech taking the spotlight this week as several of the Magnificent Seven companies report their quarterly earnings. We'll take a closer look and focus on what to watch for in a minute. But first, tech editor Dan Howley joins me with AI-related news out this morning from chipmaker Qualcomm, which has a new offering, Dan.
Yeah, that's right. They're announcing two new AI chips that they're going to launch in 2026 and 2027, the AI 200 and AI 250. You can see Qualcomm shares flying high, 12% on this news. And essentially what it does is it inserts them directly into competition with NVIDIA and AMD. They say they already have a deal with Humane out of Saudi Arabia. And so they're going to be, it's a megawatt scale announcement that they're going to be putting their chips to work there. These chips are designed for inferencing. So they're not designed to train models. They say they're specifically for inferencing. They take advantage of Qualcomm's NPU. It's a neural processing unit. They already have that available in PCs. They sell chips that run Windows machines, specifically Microsoft Surface products, as well as a number of products from other OEMs. They have the NPU built into those chips. And so they've been working on this, and they've kind of put it through its paces in the PC market, and now they're putting it out into the data center market. They say that this will be an energy efficient offering. Total cost of ownership will be beneficial for people companies that end up buying these chips and putting them to work, and that they have high memory bandwidth, which is good for AI inferencing. So a big deal here for Qualcomm. And I'll add, while they are going into competition with NVIDIA and AMD, they also say that because they're offering this rack scale solution where, it's not just the chip, but it's a whole server that can be built out, that individuals can go out and buy pieces of their setup and then pair those with NVIDIA offerings or AMD offerings. They also are allowing companies to pair their own CPU with NVIDIA's GPUs and kind of tying those together with NVIDIA's NVLink. So, while they are competing in this space now with this rack scale solution, they still are working with the companies at the same time. So it's very interesting, and it does help Qualcomm diversify beyond the smartphone, where they still get the majority of their revenue.
And investors like this, Dan. We are seeing those shares spike pretty dramatically here this morning. I think they're up about 14% right now. This is also a big week for tech earnings, right? So it's interesting also that this announcement comes ahead of earnings from many of the hyperscalers who might eventually be customers for this Qualcomm chip. Talk to me about the three sort of big picture themes that you're watching over the course of the week.
Yeah, I think the biggest thing for Microsoft or Google or Amazon obviously is the AI spend and the AI revenue. Meta obviously part of that as well. I think for Microsoft, we want to learn more about what's going on with OpenAI and kind of what that deal looks like. They announced they had a memorandum of understanding that they were, going forward to try to kind of suss out the details of that deal. We haven't gotten those yet, though. And so that's going to be very important. Hopefully, we can hear more about that on the earnings call. Obviously, AWS going down. Amazon's going to have to give us a little bit of something, perhaps, on the earnings call. They already did a postmortem where they explained what exactly happened and why that took down parts of the internet. They also will have to answer questions about their own AI investments. They do have a deal with Anthropic, but last week Anthropic announced that they're also going to be building some of their AI on Google chips. And while they already were getting funding from Google, this kind of leans them more into Google's camp a bit. And so what does that mean then for AWS? On the Meta side of things, where are they seeing the funding going? Are they starting to see better return on investment on the ad side? And then obviously one of the biggest questions that everybody has on their minds is, what about iPhone sales? Apple released the iPhone 17, the iPhone 17 Air, and the Pros. There were reports early that from Counterpoint Research that sales had been better for the iPhone 17 line than the iPhone 16 line in the US and China, its two most important markets, in the first 10 days of availability. So what does that then mean going forward? We only get a small sliver of sales of the iPhone for Q4. That's because it just comes out. So we have maybe 2 weeks tops of sales, but it does help inform what that would look like going forward in the year ahead. So we want to know what's going on there, and then any kind of news about Apple's AI plans moving forward.
All right. I hope you got lots of sleep this weekend, are in prime shape, ready for what the week is going to bring you. Dan Halley, thanks so much. Coming up, much more markets action. Stay tuned. You're watching Market Catalysts. Treasury Secretary Scott Bessent has confirmed the names of 5 finalists to succeed Federal Reserve Chair Jerome Powell. President Trump has said he expects to make his decision by year end. Joining me to handicap the selection process and talk about the Fed's decision on interest rates this week is Stephen Junot, B of A Securities Senior U.S. Economist. Stephen, it's great to see you. So, I mean, these names have been floating around out there already. It seemed, how much attention is the market paying at this point? And at this point, would they be happy with sort of any of these selections?
Well, I don't think the market's too focused on it right now, just because we have a Fed meeting this week. We're still trying to decide, is this labor market slowing down significantly? Is it just gradually cooling? What's the Fed going to do after the next meeting? How's it going to deal with the shutdown? So I think right now the market's really focused on the near term for Fed policy. Chair Powell's still there. But of course, this will come up more and more, especially if we do get that announcement by year end.
It seems to be sort of looming over the process less than it was at a certain point, Stephen. Okay, so let's get to this week then. I assume you're in the camp of they're going to cut this week. What are you going to be paying most attention to at the press conference then in the sort of questions?
So I think we're just going to be looking for, you're right. It's absolutely basically a foregone conclusion the Fed's going to cut this week. But we're going to be looking to Powell to see, is he going to give any guidance for December? Because, for our current outlook, we're expecting the Fed to basically stop their cutting cycle this week, right? And just cut twice this year, take a risk management approach. We've seen some slowing in the labor market, but our consumer card data is holding up very well. The activity data seems strong still that we do have. But the issue that Powell's going to face and that the Fed's really grappling with right now is that absent last week's inflation report, which was relatively benign, they don't really have any data to go on. They don't have official data to rely on. So what will they do kind of heading into that December meeting? So we're all going to be looking to see, is he going to commit to December? It's really doubtful given that he doesn't have much data on hand. So I would expect we're really not going to get much out of this meeting in the end of the day.
So if that's the case, how and given that absence of data, how are you, Stephen, trying to figure out where the economy stands?
Well, fortunately at BofA, we have a great set of internal data that we've done for some time. We publish on our consumer data. So we have a good read on that, a good pulse on the consumer. And that's been holding up well throughout this year, despite kind of that job market slowdown. There's also the private sector data on the labor market, ADP, Revelio, UKG, Paychecks, the list kind of goes on and on there, where you can cobble together something about how the labor market's doing. But the real issue is that we don't really have great inflation data. And that's really something that we would expect to see a relative acceleration in the fourth quarter, not significant, but still firm inflation print. So we can get a picture of consumption and labor out of alternative data. It's no substitute for the official data, but we can at least have a picture there. But inflation is really that missing ingredient. So I think the Fed's going to be doing the same thing. And then, it becomes harder to kind of walk through that dark room or, continue to follow your path in the absence of data right now. So December will be an interesting meeting for sure, especially if they don't have data on hand.
Yeah. The other thing I want to ask you about when it comes to data is we have a lot of not macroeconomic, but more microeconomic data in the form of earnings, right? We're in earnings season. We're getting a lot of these companies that are commenting on things like price increases, things like the state of their workforce. We anecdotally have seen a number of layoffs recently from the likes of Target and other companies. Are you able to extrapolate something from those kinds of reports?
Definitely. And I think what's interesting is our equity strategists have been flagging that optimism's improving. And this is something that I think is critical to our own view that we're going to see this resiliency of the economy actually lead to a bit of a broadening out of job growth over the coming months, a bit of a broadening out of the CapEx outlook. Right now, the economy has been driven relatively narrowly. We're talking about jobs being created just in the healthcare sector, investment really just an AI story. But if we get that breadth starting to emerge, I think the Fed will feel a lot better about the economy then. It won't feel as fragile, and they won't have to cut all the way to, say, neutral. They can kind of just take this risk management approach and then go on hold again for a while and see how things play out. So that's what we're taking from the earnings report. Obviously, there's been a lot of beats, so that's positive too. We've seen a positive wealth effect probably contribute to a strong consumer. And obviously markets continue to rally. So that's a positive for the consumption outlook too.
Yeah, and for that wealth effect. Stephen, finally, I want to ask you a question about U.S. and China, because we got those headlines that it looks like the U.S. and China are moving towards at least a détente, maybe some sort of framework for an agreement. We haven't talked about it as much lately from an economic perspective because it's been this sort of back and forth. But I am curious in terms of U.S.-China trade and its contribution to U.S. economic growth, kind of where we are now versus where were on the last day of 2024. How do you even sort of compare that, and what does that look like?
So, both countries, I think, have done a decent job of decoupling from one another in terms of economic impacts. The U.S. is a large closed economy, so depending on, say, exports to China, soybeans, airplanes, that's not really going to make or break the U.S. economic outlook. And the same kind of goes for China at this point, where exports to the U.S. really isn't going to make or break their economy. So I don't think that's something that we have to be too concerned about. But I think we need to see this détente that you've mentioned, because obviously some of these materials we need for autos, for defense, right? We could see supply chain disruptions if we don't get rare earths. And likewise, what we saw in the event earlier this year when the U.S. hiked tariffs to 145% on China, well, that's just not sustainable. So we can't really go up that high. So there is a point where trade really is integrated enough, and you can't decouple all the way, but they have decoupled over the years. And this really started during Trump's first administration. So obviously we got good news about the framework over the weekend. It seems like there's going to be de-escalation. That should be a positive for both economies, all else equal.
We'll see how it plays out. Stephen, good to see you. Thanks so much.
Thanks a lot.
We got more markets action coming up, including some trending tickers. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. We're watching Five Below, Honeywell, and Booking Holdings. First up, Five Below. Shares are popping after JP Morgan upgraded the stock to overweight, saying sales and earnings could top Wall Street's expectations through the first half of next year. Analyst Matthew Boss sees stronger same-store sales, but comps are tracking about 10% higher. That's well above consensus. He pointed to structural improvements in product, marketing, and the in-store experience. He also boosted his price target on shares to 186, up from the prior 154. The stock is up more than 50% this year as budget-conscious shoppers keep flocking to value retailers like Five Below, Dollar Tree, and Dollar General. Next up, Honeywell. RBC raising its rating on shares to outperform from sector perform, calling this a catalyst-rich phase for the industrial giant. Analyst Dean Drey says solid execution and Honeywell's upcoming split of its aerospace and automation units next year could unlock new value and boost profitability. He also raised his price target to $253 a share, implying about 17% upside from Friday's close. And finally, Booking Holdings. Shares are up after Truist Securities turned bullish on the travel platform, citing multiple opportunities for earnings growth. Analyst Gregory Miller highlights Asia's travel rebound and steady global growth and says investor fears about AI competition are overdone. He lifted his price target to $5,750 a share, up slightly from his prior forecast. We'll keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching Tesla, GameStop, and American Waterworks. First up, Tesla. Board Chair Robin Denholm asking shareholders to vote for CEO Elon Musk's nearly $1 trillion pay package ahead of the company's annual meeting. The proposed plan for Musk consists of 12 tranches of shares granted to him if Tesla hits certain milestones. Denholm said in a letter that Musk was key to the future of the EV maker as it moves beyond being just another car company, and basically said that they were in danger of perhaps losing him if this was not approved. Next up is GameStop, getting a boost earlier from the White House. The White House's X account shared a photo of President Trump as a character. Well, it wasn't a photo. It was an AI image of President Trump as a character from the video game Halo. It comes after Microsoft announced that it would be releasing a remake of the game on Sony's PlayStation 5. GameStop then came out with a comical press release on the end of the console wars, as it put it. All of this fueling early gains, which have now mostly fizzled out. And finally, American Waterworks. The company will merge with Essential Utilities to form a combined water and wastewater public utility. It's an all-stock deal and will have a combined enterprise value of about $63 billion, the combined company. American Water will also conduct a review of strategic alternatives for its non-water and non-wastewater businesses. The company's CEO, John Griffith, will serve as CEO of the combined company. Essential CEO will serve as executive vice chair of the board. Both stocks are trading lower. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we're talking with IBM about the company's quantum efforts, which sent the stock on its best day since January. We'll be right back. IBM shares have been trading near a record and on Friday had their best day since January after reporting that it can run a key aspect of its quantum computing using chips from AMD. In a statement, the company called the milestone a, quote, significant achievement towards building its full quantum computer by 2029. For more, I want to bring in Jerry Chow, IBM Quantum Systems Director. And I believe you guys actually brought up your goal of when you'll be able to achieve this, Jerry. Thank you so much for joining us. So talk to me about, and you guys are out with a white paper today as well, talking about the advances that you have made. It seems as though most significantly, quantum computing, which can result in a lot of errors, is very productive, but there are errors as part of them. You've found a way to decrease the errors. Do I have that right? And can you explain to me how and why this is significant?
Yeah, so we came out with an aggressive path getting towards a fully fault-tolerant, error-corrected machine by 2029. That was part of our roadmap earlier in the year. Now, a key aspect of making that actually work is fundamentally figuring out where the errors are in a real-time fashion and correcting them. And there's actually a classical computing element of that needs to be done. It's called decoding. And so our news is actually about working out how to use a real-time algorithm in a short amount of time using standard, in fact, in this case, AMD Xilinx FPGA chips in order to do that kind of algorithm.
And why is it important that you can use an AMD chip that's already out there to do this kind of work?
Yeah, so this type of decoding work has always been looked at as something that could be very computationally expensive and difficult. And some have suggested that you might need to use large GPU clusters. And we certainly know about the energy and cost implications of using things such as GPUs. And so really this gives us a different way of looking at it, that in fact, with the right type of algorithm, we can do this in a very short amount of time and on much cheaper types of hardware. It's just the beginning, of course. There's still going to be a lot of work to fully flesh out this type of algorithm towards what we need for 2029. But it shows that we can really start to work together with partners such as AMD to develop this kind of future.
And so in 2029, as you mentioned, is the date that you're focusing on. What will happen in 2029? What milestone are you guys trying to achieve? And then what do you do with it?
Yeah, I mean, it's really exciting right now. There's so much going on in quantum computing. There are systems already today that we're putting out that are at the 100 qubit scale that are pushing on problems that you can't, in fact, solve classically. Now, the question there is whether or not those are actually applicable for things in the enterprise. In 2029, with Starling, our goal is actually put out a machine which is fault tolerant and error corrected at the scale of 200 logical qubits, which can actually run out to what are called quantum circuit sizes out to hundreds of millions of gates. And that has a significant impact on potentially being used for a lot of the provable advantages that we actually have probably read about or heard about for quantum computing to be applied to in chemistry, in finance, in optimization, and so forth.
Jerry, we've seen this really interesting phenomenon in the market where quantum it's still early stage, it's still a few years out for most applications. People are really excited about it, and they're excited about the investing case, the innovation case, and what this could do. As somebody who's actively working on this stuff, what do you find sort of most exciting about the potential here?
Yes, I mean, it's quite a wild ride. I'll certainly say that. There's been a lot of news almost every week. You're hearing about news in terms of quantum computing. But to me, what is really so amazing about working in this industry is really the pace and the momentum that we're driving from a roadmap perspective. There's a lot of work that's going on throughout sort of reinventing how computing is done. And we have a multi-year roadmap that shows how it integrates with your computers of today, CPUs and GPUs, and there's real future of computing footprint that we need to define that's going to be so rewarding when it all comes together.
Jerry, there are some of the small competitors to IBM that are sort of more pure play quantum computing companies that are sort of putting some of these systems in place today. And it's my understanding, and to be clear, my understanding is pretty rudimentary, that there are sort of different approaches. There are sort of annealing approaches, gate quantum approaches. Is that the difference between what you guys are working on and some of the systems that are in place today? Can you sort of decode that, to use your word, that aspect?
So there's the quantum computers that we build, you can think of them as fundamentally they're running what are called quantum circuits. Some might call that gate model kind of quantum computing. But the point there is that these circuits are what we have actual provable potential advantages for. And what we know that today, even at the machines that we're deploying, and we have 15 machines that are deployed, quantum computers over 100 qubits around the world today, that they can actually run workloads and algorithms that you cannot classically simulate. And so really that's this differentiating piece, right, in terms of what we're trying to be able to leverage this. And there's a lot of effort already going on in, we'll call it the scientific computing space, much like early days of GPUs, where people are really pushing the boundaries of what you can use these machines for. And then, as we continue to leverage it and interface it with these other computers like CPUs and GPUs, it's really exciting to see the kind of advantage pushes that we're going to see over the next few years.
Jerry, as you know, everyone right now is very focused on AI, generative AI, and the sort of advances that could bring, even though we're still figuring out what those use cases will be. How would you compare that to quantum and what quantum could do for the use cases in which it's going to be implemented versus what we're seeing from generative AI?
Yeah, it's a really good question, and something that we often hear about, right? Because we expect all this exciting stuff to happen with generative AI, and it's solving all these different types of problems that we care about, from optimization, chemistry, and so forth. But really also the way to think about quantum computing is it's a fundamentally different way of computing, right? So it actually has algorithmic advantages over anything that you can do using traditional computers, be it CPUs or GPUs. That being said, though, it's really, really exciting to see how they actually thread together. And there's already work that's being done in terms of using first AI for quantum in ways to accelerate how we develop the quantum computing protocols, develop the algorithms, how we map problems onto quantum hardware. But then there's also the other side, which is how quantum is going to accelerate some of the problems that AI is also looking at, from optimization, from machine learning, and from characterization, classification, where there are actually provable algorithms that we know that quantum has the ability to really accelerate and push to the next level.
Is there a risk, Jerry, that all of this build out of infrastructure that's happening right now will be made somewhat obsolete by quantum? In other words, once you sort of crack the quantum problem, can that power future generations of AI?
Yeah, I think the thing there to think about more is that it's really complementary, right? So there's a lot that's still being done today, obviously, with scaling out these large data centers that are full of GPUs. But in terms of some of those types of processes that we expect these GPUs to be good at, quantum is really doing something different. And it's really looked at as something that's complementary, right? But really expands the scope of what's possible and what's actually can be computed. And so we really see it as additive. Of course, there might be problems which we might offset, right, from one to the other, and we're exploring exactly that type of work with partners such as at the Riken Institute in Japan to see how we can use quantum to replace some of existing supercomputing workflows. But that's all part of the discovery phase that we're in right now.
It's very cool, even for a layperson like me. Jerry, thank you so much. Really appreciate it.
You're welcome.
We got much more markets action coming up. You are watching Market Catalysts.
All right, in today's Power Player segment, I welcome on incoming T-Mobile CEO Srini Gopalan. Srini takes over from longtime CEO Mike Sievert on November 1st. His mandate, keep the T-Mobile growth machine humming along, just as its two large rivals aim to stop him.
Well, look, I'm really excited about taking over November 1st, but the reality is I've been associated with this business for a long, long time right now, really familiar with it, and really looking forward to kind of taking us to the next step on the Un-carrier. It's what we call unleashing the Un-carrier, and that's really about widening our differentiation. Because, this huge success story that the Un-carrier has been built on, for most of our time, that differentiation has been because we've offered great value and a great experience. Now, we have America's #1 network. And so our differentiation is going to go from being based on value to being based on value, network, and experience. And so at the heart of it, there are no trade-offs at T-Mobile. Whether you want value, experience, or network, there's only one place to be at.
So when I was starting my career, I covered the tail end of John Leisure's CEO tenureship. Mike Sievert I've covered from bookend to bookend. They've been outspoken leaders in this industry. Is that the path you will take as a leader?
Look, my focus is on really driving our differentiation, and outspoken is about stating what we have and making it clear that every American knows that there's only one place where there are no trade-offs. So the path I'm on is unleashing the Un-carrier. It's building on everything that John and Mike have built, which is a fabulous company, and really driving it to the next level.
I get the sense that you're going to be focused early on, not only maintaining momentum in the wireless business, but fiber, and expanding upon this industry theme of convergence. Like, what are some of your early focus points going to be?
So early focus, three big things. Network differentiation. We've got the best network. We want every American to know that. Digital transformation, which is just making it easy for people to buy their wireless, making it easy for people to service their wireless. I often say this, it's a bizarre contradiction, but we use our mobile phone to buy everything except the mobile phone itself. That's got to end, right? We've got to make this industry live in 2025, not in 2002. The way mobile transactions and wireless transactions are done feels like it's from 20 years ago.
Well, how do you change it?
You change that by using digital capabilities, by using AI, right? You bring those things to bear and you work with customers and your employees to make that transition. And the third piece is something you referred to in passing there, which is not just fiber, but broadband more broadly. And we can talk about that. But those are the three big focus areas.
Samir, I want to get into this quarter too, but
sure.
They're also, the folks that came before you, they've made some very big acquisitions. Will that be in your arsenal? And are there more acquisitions to be had out there to expand T-Mobile? I think of Sprint, I think of the fiber acquisitions, you name it.
See, the way we think about acquisitions is fundamentally back to capital allocation. We've run really disciplined capital allocation. That capital allocation includes, what we start working back from. We believe the right level of leverage in this business is 2.5 times our EBITDA. And then we work back from that to say, what else can we do to drive the organic business? I view Spectrum, for example, very similar to M&A. It goes through the same process of looking at it. We've been very open about the fact that we're open to fiber acquisitions, right? And then once we've done funding the momentum of the core business, the rest of it is shareholder remuneration. That's the way we'll think of all of it.
You've been T-Mobile putting up really good quarters for a long period of time, but this one just stuck differently to me. 1 million postpaid phone net customer adds, that was a big number. What was the biggest driver in that upside versus estimates?
The biggest driver is our widening differentiation. I just want to step back for a minute though. We've been the growth driver in this industry for 13 years, the Un-carrier. And this quarter, we added more new customers than ever before in our history. That's momentum. And that momentum's coming not because of kind of promotions and stuff like that. Yeah, we're competitive. But the heart of it is widening differentiation. More and more customers are realizing that you can get the best network along with best value. You don't have to trade off. Right? And that's driving a lot of the momentum. What I'm really pleased about, though, is not just did we drive all that volume growth, our bottom line results, 6% EBITDA.
Well, that's been a huge driver of the T-Mobile stock price for a while, in operating profits.
And our conversion to cash, right? And that will continue to drive us.
I want to get your take on some comments. One of your competitors came on a couple hours ago, AT&T COO Jeff McElfresh, and I haven't talked to him in a while, but he came on. And these are his words, not mine. He said, T-Mobile has, quote, been deceptive on pricing. What would you say to that?
Well, that's interesting coming from an incumbent.
And I'm not used to hearing this from AT&T. I mean, usually they say nothing at all.
I can only believe that that's because of some of the pressure they're under. Look, the reality is we've always prided ourselves on changing the industry for the good of the customer. And that includes transparency in how we price. In the end, the best reflection of all of this is not us calling each other different things in the industry, right? That's not the game we play. We look at what is customer satisfaction. We look at what is NPS. We have an industry-leading NPS. That doesn't come with lack of transparency. That comes with transparency. That comes with really caring about our customers and truly believing in changing this industry for the good of customers.
90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. Taking a look at the major averages here this morning, we've been seeing a rally for them that has taken them to new record highs. The Dow up 226 points, that's about 0.5%. The S&P 500 up 0.9%. And the Nasdaq gaining 1.4%. Many of those large cap tech companies that are reporting their numbers this week are rising today, and Qualcomm in particular also making some headlines, introducing a new data center chip, and the shares up big today. Let's also talk about the backdrop for the stock increased today. While President Trump is making headway in trade talks in Asia, things with our neighbors in Canada get frosty. Trump is striking trade deals across Southeast Asia and expressing confidence that an agreement will be reached with China that does not involve higher tariffs. Meanwhile, Canada is getting slapped with an additional 10% tariff as talks there stall. Joining us now to break down the latest, Henrietta Treys, Veda Partners Managing Partner and Director of Economic Policy. Henrietta, it's good to see you. Let's talk China, first of all, and what we've been seeing come out of Asia in terms of the rhetoric that seems a little bit more positive. So what should we be looking for to see if that rhetoric turns into reality?
Right. We really want to hear from the Chinese delegation, want to hear President Xi confirm that there's maybe going to be some purchases of soybeans, which would be a major relief to U.S. farmers who are struggling under what they're calling Farmageddon right now. A focus on what China says is going to be most important. They have some different language than what we're hearing from Treasury Secretary Bessent and from President Trump. So we're going to want to get confirmation, which probably won't come until Thursday of this week, but definitely looking like we're going to get basically a rewind and a reset back to where we were more towards the beginning of this year, before the escalation threats of the last month.
And what about, in particular, some relief for farmers on the soybean front, right? That we've talked to some farmers. I know that's an acute sort of point of tension between the U.S. and China. So expect any breakthrough there?
This is the critical piece because, of course, not only has China retaliated for President Trump imposing these tariffs when he took office, but they actually have never lived up to their phase one agreement reached during his first term. So China has quite a bit of room to make purchases and grow that they have been spending the last 8 years diverting away to Brazil and Argentina, much to the chagrin of U.S. farmers. So that dynamic is really going to be a lifeline to President Trump specifically, and it as read through to the U.S. shutdown. If China buys soybeans, then the president is under a little bit less pressure to reach a deal with Democrats that could compel them to give some funding for a bailout package domestically. So one of these two things has got to give.
And what about on the rare earths front, or rare metals front? What do we expect there? That some sort of negotiation, something worked out?
Yeah, so kind of like I said at the outset, what we're looking at is maybe China reeling it back in as well and saying, okay, the very aggressive restrictions on and licensing requirements that we were going to require will maybe delay. Treasury Secretary Bessent is sort of alluding to potentially a year-long delay. There are officials from Beijing going to negotiate something very similar with the European Union right now to clarify to global market chains that they're going to provide magnets, chemicals, and rare earths that they have a monopoly on, while the U.S. is perpetuating this trade war. So a lot of damage control, again, resetting to where we were earlier this year.
Meantime, Henrietta, we have continue to have this weird flip on its head of traditional trade relationships, where here we are talking about potentially coming to a framework for a deal with China, where at the same time, the president was upset about that ad out of Ontario, featuring President Reagan. And now we've got higher tariffs on Canada potentially. Do you really expect that to go into effect?
Yeah, this is really where we get into a question of the Supreme Court case, which is going to have oral arguments next week. The president is imposing tariffs because he didn't like an ad that correctly depicted Ronald Reagan decrying tariffs and explaining that they have a massive regressive impact on U.S. consumers and end up hurting free trade, hurting the U.S. economy just as much, if not more so, than anybody else. So the president's ability to unilaterally impose tariffs wherever he sees fit and whenever he sees fit at whatever rate is really the heart of the matter of the Supreme Court case. And I think, frankly, from a legal perspective, he hurt his standing going into oral arguments next week. And that's going to be a major topic of whether the president should have this authority at all.
Henrietta, remind me, how long is that case expected to go? When can we expect a conclusion?
My base case is that we'll find something out in mid-December. The Court of International Trade and the Federal Court of Appeals both found earlier this year that the president does not have this authority to impose tariffs. And they found that from start to finish of their cases in less than 35 days. So there's a lot of optimism in the legal community that we might get this done before mid-December, which would be, lightning quick for the Supreme Court. They don't have to give us a verdict until next summer. But given there's about $4 trillion on the line, people want to know what's up.
Yeah, they definitely do. And speaking of a lot of money being on the line, the shutdown is still happening with you're in a better seat than I am. Any glimmers of hope anywhere there?
I can't even be kind about it. No, there's no hope. There's no forward progress. The House Republican Conference is going to be out all week. They're not even going to be in D.C. With the president over in Asia and not willing to use the auto pen, he will not be signing a bill to reopen the government, even if one comes to his desk. The Democrats are going to be coming back to D.C. They'll be holding press conferences. The whole caucus will be there on the House side. But there's no shakeup in negotiations. There are some federal workers unions who are calling for a vote on the clean CR and for that to pass and reopen the government for at least a little while. But basically, until late next week, I expect we're going to be closed.
All right, Henrietta, good to see you. Hopefully we won't be having that same conversation the next time that we talk. Yeah. Thank you.
Thanks for having me.
Well, we were just talking about rare earth and that discussion point between the U.S. and China. The stocks here in the U.S. are taking a tumble as those trade tensions ease between the two nations. We saw those names rally on reports that China was considering export controls on their rare earth materials, pushing President Trump to threaten 100% tariffs on Chinese goods and focus on U.S. development in this space. So what is now the investment case for those stocks? Joining me now on this, Neil Dingman, analyst at William Blair, who covers these stocks. Neil, it's great to see you. Wow, there have been a lot of headlines around this space and a lot of interest in this space. And today we did get some news out of Southeast Asia that the president is looking into some deals with those nations on rare earth minerals. So I guess, first of all, just set the backdrop for us as to the homegrown industry here and what the backdrop is for them.
Yeah, it's good to see you again, Julie. The backdrop is still very difficult domestically because you think about 70% of the mining still comes from China. About 90% of the processed or oxides of the rare earth comes from China, and about 93% of the magnets. So again, the way I looked at it is, looking at this over the weekend, some sort of concession is likely not going to be terribly negative. In fact, going to be necessary because the timing it's going to take for the U.S. or other U.S. allies, Latin American countries or anybody else to ramp up these needed rare earths, it's going to take time and going to be very necessary. So again, as one of my companies mentioned recently when I was with them, they're not able to compete with China by any means in the foreseeable future. Anything that they're going to supply is going to be 2 to 3 times the cost. But I think it's still going to be very necessary, again, to have some sort of concessions from China in order to have something come to the U.S.
So, and do you think that even if there is some sort of agreement inked this week or whenever it is, that there will still be an emphasis by this administration on investing in these companies? I mean, do you think basically any rare earth company based in the U.S. is a potential recipient of investment dollars from the administration?
Absolutely. I think maybe not necessarily a direct stake as they've done with MP and some others, but at least I think some sort of backstop is going to be necessary for the U.S. companies to continue to build out either the far end, which is the magnets, or the middle part, which is again the processing or the oxides, or even to start with the mining side, with the very front end of that. So again, why I'd prefer a lot of the companies wouldn't take a direct stake. I would prefer, again, and I think it's going to be necessary that the government comes in with some form or fashion of a backstop to make sure that these continue to get built out in the U.S.
Neil, as you mentioned, it's a long time before maybe some of these mines would even begin production. So do you see them as sort of a short-term, more tactical holding for people? Or do you think this is a long haul thing? But if that's the case, how long do people have to wait for that stuff to bear fruit?
I think it'll be a combination. I think if you're just playing a U.S. company that it's going to just stick purely domestically, it is going to take a while. You're talking probably a minimum of 2 to 3 years. I think what you might see, much like the president signed 4 other agreements with Southeast Asian countries, which again means that potentially a U.S. company could partner with any or all of those, Vietnam and you name it. I mean, there's talks about, he was in Australia last week. They could partner with somebody like that. So I think to expedite the timing, any of these domestic U.S. companies potentially partner with a non-Chinese company and really expedite the timing. I mean, then you're maybe talking a year, maybe two at most, whereas if a U.S. company decides to go at it on their own, as I said, I mean, you've got companies like NowCorp that said, the minute we get funding, it's going to take us 3 years to build out our mine.
Right.
So again, I think these allied partnerships are going to be a key behind this.
What is still the risk, Neil, that even if you get U.S. processors going, miners, at whatever stage, the risk in the past, and one of the reasons that these U.S. companies have had so much trouble capitalizing, is that China can kind of flood the market, right, and bring prices down. So is all of this contingent on a U.S.-China agreement that prevents that from happening?
It's going to be a total prevention, but again, part of that is going to have to be some form or fashion where the U.S. companies, the users, the end user, the defense, EVs, you name it, auto industry, anything that uses magnets is going to have to source U.S. Again, if they want to just go after lowest price in the foreseeable future, yes, they're going to try to do an end around and maybe try to go through some of the Chinese production. But again, I think it's going to be necessary that the government also, in some form or fashion, works with on the demand side. Maybe somebody, you're talking about an EV or somebody that uses these goods, maybe give them some sort of benefit by using domestic magnets versus just going to end around and using the Chinese magnets.
Neil, we've been showing your picks here. It's NeoCorp, USA Rare Earth, American Resources, Royalty Management, US Antimony are the various picks. Do you have a favorite, or do you just think it's safest to sort of buy the basket?
I think the one that is probably nearest term is USA Rare Earth. Why I say that is they just recently purchased, they haven't closed yet, on a very strategic UK company called LCM, Less Common Metals, that is going to provide the metals and alloys. Number two, they have a very large magnet factory in Stillwater, Oklahoma, not far from here in Houston, that's going to start up right around year end. So again, I think it's going to be very critical, no pun intended, when both of those, the acquisition in UK gets completed and when the US magnet facility begins production, which is going to be sooner than later.
Neil, great to see you. Thanks so much for joining us.
Good to see you again.
Take care. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day, and we are firmly in the green here. You're seeing gains being led by the NASDAQ Composite up over 1.5%, the Dow adding around 200 points, and the S&P 500 also up around 0.9%. And this comes on the heels of more positive trade developments between the U.S. and China. President Trump, along with Chinese President Xi Jinping, they are set to meet in South Korea later this week. That meeting is set to take place on Thursday. And over the weekend, a lot of positive rhetoric when it comes to a potential deal and the possibility that 100% tariff on China that's set to take place on November 1st, that might not happen there. So that's helping boost the broader markets today. Now, we also have earnings results on deck this week by some of those big tech giants. We have names like Microsoft, Alphabet, Meta, Apple, Amazon, all reporting this week. You're seeing today a lot of green across the screen, not many companies trading in the red. And on a year-to-date basis, even better story there. You're seeing names like NVIDIA, Alphabet up over 40%, Microsoft, Meta up over 25%. Even Apple, which is one part of the Mag 7 that's struggled to compete as AI. The AI story just hasn't really been there for analysts and investors. That stock has now flipped into the green on the heels of a surprising upgrade cycle for the company's iPhone. So just overall, sentiment seems to be really high on a year-to-date basis. On a sector basis, you're seeing that tech No surprise there, leading the way higher along with communication services and utilities. Utilities also part of that AI story. But keep it right here in Yahoo Finance. We'll be tracking all the market moves throughout the session.
Holiday shopping season just around the corner, and despite trade tensions cooling since Liberation Day, companies and investors are still waiting for the U.S. and China to reach a trade deal. Joining us on this now is Kareem Kaffouri, CEO of the Atlas Network and author of Supply Chain Ups and Downs. Thanks for being here.
Thank you for having me.
So, Kareem, we have this news out of Asia today that maybe we're getting closer to a U.S.-China deal. But how much have companies adjusted to the tariffs and the supply chain back and forth in order to have us well supplied for the holiday season?
Sure. Well, businesses are nimble, and they know how to adjust accordingly. So we hear from the studies and research that so many have stockpiled or have bought in advance to accommodate what we're going to see here coming into the holidays, which is going to be a significant amount of bargain shopping. Everyone's going to be looking for those opportunities. Every time there was those 90-day pauses, businesses were jumping on top of that. We saw imports skyrocketing. And so in accordance with navigating these challenges, businesses do what they always do, which is find a way, and an innovative way at that.
And so not only then, it sounds like that they have the supply they need, but will they be able to provide it at the prices that consumers will pay?
Well, again, I think that it comes business to business, product to product, industry to industry. And depending upon what strategy they had put in place, whether it was absorption, deferral, terms and conditions, price engineering, or alternative supply chains, many businesses had opportunities to look at ways to still be able to get products to consumers when they needed them and at a price that they needed them for. We think about things like the holidays, and 87% of our decorations and artificial trees come from China. We think about things like Thanksgiving coming and the cost of vegetables and fruits and all of the peripheral items that you need for those celebrations. And businesses need to think ahead accordingly, but at the same time, consumers need to budget shop.
Gotcha. And so when we lead up to those holidays, what to you is sort of still the biggest potential conflict point or tension point or weakness point? Is it logistics? Is it labor? Is it raw materials as we go into the holidays?
I think it's really many of these things. And I think from a consumer to consumer basis, it'll change and shift a little bit. Consumers will have to, of course, sort of understand that everything may not be as available as it has been previously. They may not be able to buy multiples of products because of a level of scarcity. And some of their brands that they've come to know and love may not be available, but there may be alternative versions of this. And so from a business standpoint, there are opportunities where certain companies can kind of make entrance into the market knowing that their competitors are having restrictions in their supply chains. So again, it's this scenario of opportunities through chaos for both consumers and for businesses. And each one has to look at it in their own perspective to determine how they can take advantage of the ebbs and flows that consistently have a global supply chain, whether it's today, this environment, or the pandemic a few years ago or otherwise. But the most important thing is that consumers get what they need when they need it. That is the ultimate, fulfillment of a global supply chain.
You mentioned the pandemic, and of course we talked a lot about the supply chain then and how it needed to be modernized and updated. How much of that work has happened, and what are some of the biggest lessons that now logistics providers have learned from that they're applying to this situation?
I would love to say a lot more has been learned than it has been, but unfortunately, in the world of business and economics, we usually look at what's the most immediate threat. And I think once the pandemic sort of settled down and everything, businesses didn't take as much advantage as they should have. In my company, what we help customers do is we look at worst case scenarios. What happens if you don't have your product for the next 6 months? What happens if you have a strike at the ports, or you have a pandemic or tariff scenario, whatever it may be? Because it's those uncontrollable factors that continue to dominate the supply chain that no one can really fully anticipate. So you have to assume kind of a worst case scenario and plan for a better outcome. Some of these businesses have done a good job of that. I would say the vast majority of them have not. And so accordingly, this is why we see such an impact to the markets with the news. We have one day tariffs are sort of on a reprieve, and then another day they're in full action, and the markets are accordingly having a direct impact that is not very sustainable.
Right.
And so in this way, I think that consumers and businesses continue to face these challenges because of a lack of preparedness.
When it comes to your customers, and you guys, you also deal in packaging, right?
Yes,
so
yes.
How much of that raw material is tariffed at this point, and how consistent is it?
Yeah, I mean, a certain amount of it is tariffed, but it's not necessarily only because of it being a material, but more its country of origin. That's really what we're dealing with more than anything else. It's kind of two-sided. There's tariffs that are placed on materials themselves. There's harmonized tariff codes when you bring goods in, according to a classification of what the product is.
Right.
And then outside of it, just this widespread tariff because it comes from XYZ country.
Right.
All of these are challenges to face. We have looked to actively work with our customers to help them to determine whether keeping their existing supply chain or looking to alternative ones is the better move. This is a mixture of looking at materials, output, resources, technology, and finally the costs to determine whether nearer is better or move to a different location. And if all of these pieces are not really in play, then the entire supply chain can break down, and it would be better for you to just pay the tariff and accordingly figure out how to manage the excessive cost.
Yeah, so you have to weigh those factors.
Correct.
Yeah,
correct.
Kareem, thanks so much for coming in.
Thank you so much for having me.
See you.
Really appreciate it. Thank you again.
That does it for Market Catalyst. We'll have more on Yahoo Finance after the break.